Investors woke up to a mixed bag on Wall Street today. U.S. market futures were all over the place. It's like the market can't make up its mind. The Dow Jones Industrial Average futures took a tumble, dropping nearly 1.5%. That's over 500 points, folks. Meanwhile, the S&P 500 futures inched higher, up by 0.5%. And the tech-heavy Nasdaq Composite futures also saw a slight gain. This uncertainty reflects the nervousness gripping the market. We're seeing a tug-of-war between positive earnings, surprises, and lingering economic concerns. Adding to the anxiety is a slew of economic data that came out this morning. Jobless claims for last week unexpectedly fell. That's usually a good sign, right? But hold on, continuing jobless claims actually rose. This suggests that while fewer people are filing for unemployment, more people are staying unemployed for longer periods. It's a mixed bag, folks, and the market doesn't like mixed bags. On the housing front, we saw more weakness. Housing starts, a key indicator of the health of the real estate market, plunged more than expected. This indicates that rising interest rates and inflation are continuing to weigh on the housing sector. However, there was a glimmer of hope in the building permits data, which actually exceeded expectations. Now let's talk about a company that's bucking the trend: Taiwan Semiconductor Manufacturing Company, better known as TSMC. This semiconductor behemoth is the world's largest contract chip maker, and they just reported blowout earnings for the first quarter. We're talking a 60% surge in profit. That's right, you heard me correctly, 60%. What's driving this incredible growth? Two words: artificial intelligence. TSMC is a key supplier for companies like Nvidia, which are at the forefront of the AI revolution. As demand for AI chips continues to skyrocket, TSMC is reaping the rewards. Their revenue for the quarter soared by 42% year over year, reaching a staggering $25.85 billion. Adding fuel to the fire today were comments from President Trump about the Federal Reserve. In a post on his Truth Social platform, the president criticized Fed Chair Jerome Powell, calling him too late in his response to inflation. The president has long been a vocal critic of the Fed's interest rate hikes, arguing that they are stifling economic growth. The president's comments come at a time when the Fed is facing increasing pressure to tame inflation without triggering a recession. The central bank has already raised interest rates 6 times this year, and it is widely expected to announce another rate hike at its next meeting in May. However, some economists argue that the Fed is moving too aggressively and that its actions could tip the economy into a recession. Adding to the uncertainty is the European Central Bank's ECB decision to cut interest rates for the 7th time this year. The ECB is grappling with sluggish growth and deflationary pressures in the Eurozone, and it is hoping that lower interest rates will help to stimulate the economy. However, the divergence in monetary policy between the Fed and the ECB is creating volatility in currency markets, which could have ripple effects throughout the global economy. The bottom line is this: the Fed is in a tough spot. It needs to strike a delicate balance between fighting inflation and supporting economic growth. And with the president breathing down its neck, the central bank is facing even more scrutiny than usual.